Santanu Sengupta, Chief India Economist at Goldman Sachs, joins in. Shantanu, welcome to the show and always a pleasure to speak to you. This is Hiral on this side. You have the India-US trade deal that is done now. Budget announcements pretty much in the system. And you have the RBI policy tomorrow. If you have to take all of this into consideration, what is that setup looking like and what would your key highlight be?
Yeah, thanks for having me again. Look, the growth trajectory looks pretty constructive for us. We have raised growth numbers already by 20 basis points. We are looking at 6.9% year over year for calendar 26, 680 for 7% for fiscal 27. And if you put the whole thing together, you are having this export boost now, probably with a lagged impact of the trade deal having been done. You will get to see some investment pick up as well. All of that we have not baked into estimates. And then if you think that the budget has more or less been in line with expectation, 4.3% of GDP fiscal deficit, they're on a declining debt to GDP path. CapEx is being given a push through 10% growth. The overall borrowing number slightly higher than market expectations. This setup looks to us like a pause from the RBI going into the Friday meeting. We think that the RBI is on a pause from here on. We don't expect any further cuts because if the growth trajectory is becoming more constructive, inflation is getting back towards the RBI's target of 4.5% by the middle of the year. Then we don't think that the RBI will be easing any further. The focus from them will shift towards more liquidity and transmission of rates.
Okay. Shantanu, very good morning. Alex here. I'm just wondering whether you're adjusting any of your other estimates as well. And you spoke about the growth estimate. I wonder what happens to inflation, and one would assume that to a certain extent with the pressure off, relatively speaking, on the rupee, whether that has a bearing at all in your estimates from the perspective of crude imports and the cost there. What are you thinking about that? And then from that point, are you adjusting nominal as well heading into FY27?
Yeah, so three parts: inflation first, then FX, and then nominal. Look, on inflation, you'll have a new basket, the new CPI basket, which will be revealed on February 12th. So a new CPI number. Our sense is that the number, if you just go with the kind of weights that the MOSPI has already come out with, and if you plug in the older index, CPI index, it'll just look slightly higher, maybe by about 40 basis points or so. And that will basically mean that by the middle of the year, you are at about 4.5. So we are not really adjusting our inflation numbers until the new CPI basket is revealed. You have seen a little bit of base metal prices increase that will start feeding into core inflation, core goods inflation. Overall, if growth is better, we think that core inflation will be slightly higher by the end of the year. You're already seeing some margin pressure for the companies also in terms of higher input costs. All of that, again, put together means that, inflation is slightly higher and therefore RBI is on a pause. On the FX, undoubtedly, the deal is great news for the FX markets and it's already reflected in the price action yesterday, right? But our sense is that with a large short forward book that the RBI is running, even if you have FII inflows come in, you will probably settle at around this 90-92 rupees per dollar kind of range for the near term until the short forward book is run down to a point where it is more manageable. It's about $65 billion as of November. And our sense is that the RBI would want to run it down to about half the size at least to feel more comfortable. In terms of nominal GDP growth, with inflation picking up, our growth estimates already, as I said, is closer to 7% for the year. We think that nominal GDP will be in line or slightly above what the budget has estimated. We are at about 10.5% for the next year, just on the basis of the fact that inflation is picking up slightly.
Shantanu, hi, Tamanna here. So clearly the details of the deal are scarce as of now. We just know what has been said publicly, but we don't know what the fine print is. Just trying to understand if there is indeed a complete closure or stoppage of Indian imports of Russian oil. what is the impact to India's import bill in that sense? And if all of those are diverted to, say, American/Venezuelan oil, how does that work out for India's economy?
Great question, Tamanna. The details are still awaited on the deal. Our sense is that India is importing roughly 1/3 of the oil import from Russia. That's about 1.5 million barrels a day. It's very difficult to switch overnight into some other source. So even if you ramp up Venezuela or U.S. oil, I think it'll be quite difficult to switch immediately 1.5 million barrels a day. But what will happen, and what has been happening over the past 6 months or so, is that the U.S. share in India's imports is increasing. And I think what you'll see over the course of 2026 is that as Venezuela ramps up production, you will see more imports coming in from Venezuela. So if you look at the LATAM shares in the Indian basket, it's actually declined over the last 3 or 4 years. You will see that ramping up. Difficult to imagine that Russian oil imports will go to zero overnight. I think what you want to see is a declining trend in terms of Russian oil share and an increasing trend in terms of US and Venezuelan share. I think that's where sort of the equilibrium will be by the middle of the year. And then later in the year, you can see whether the Russian imports can go down even further. Yeah. In terms of, does it materially change our current account view? I think no. We are at about 1% of GDP current account. With the trade deal, you'll probably be about 10 or 20 basis points lower. So I think you're in that range, which does not really materially impact your external balances view.
The second part of it, how is India going to push its annual imports from the US to 100 billion? I think it's 500 billion over 5 years, as I understand. So just that headline number has come in, and you're at about 45 billion right now, if I'm not mistaken. How are we going to double it? What are we going to buy?
No, so the exports are slightly higher. I think what you will end up seeing is that defense and energy will be the big trade-ins that will happen from the US. You are already doing a bunch of defense purchases that will increase. Energy we just discussed. Our sense is that you will also have some machinery, capital goods, higher-end tech product imports happen, and shore up domestic manufacturing capacity. From the export side for India, remember that pharma and electronics was never under the purview of tariffs. So the effective tariff rate for India was always lower than the actual 50%. Our estimate was about 34-35%. So I think you'll continue to do electronics more. You will continue to do pharma, but the laggards over the past 3 months, clearly, which have been the labor-intensive exports like textiles, gems and jewelry, marine products, and so on, that will get a leg up. So I think that is the way you're getting towards a higher nominal number in terms of exports.
Okay. So Santanu, with all of this now, the key is what will the RBI do tomorrow? What's your expectation? Because your projection has been pretty much neutral in terms of approximately 150 basis points in totality, if I'm not mistaken. Now, you're talking about food inflation that could stabilize on the back of the lower basket weight. Does this create room for the RBI to actually cut rates deeper than anticipated, or how do you see it panning out?
No, I think we are thinking that the RBI is in a long pause from here. The slim chance or the tail risk that you had of the RBI easing further, in our view, is taken out now by the trade deal coming through. I mean, the point that we have been making is that we have 125 basis points of overall easing already from the RBI. Don't forget the regulatory easing that the RBI has done over the course of last year. It's been underappreciated in our view by the markets until now, and the liquidity easing. Beyond that, the only risk case was of a 25 more if the trade deal did not come through, if the 25% additional tariff stayed, and that would be a headwind for growth. Now that that is being lifted, and the fiscal math is pretty clear in terms of government spending and how the budget deficit is going to look like, and we think that the economy is already in a slight bit of a cyclical upturn. We think any further easing from the RBI is completely taken out. We think that the RBI stays pat with a neutral policy stance for the foreseeable future.
Okay, thank you, Shantanu, for joining in. So that's the view coming in when it comes to the RBI, what they could be doing as well.